All right. Welcome back.
Hey
Welcome,
guys.
welcome to Friday, the final and last day for the 2021 Sofa Summit. We did save the best for last because Sean is up. What are you going to talk
Oh,
about?
well, thank you, Mark. Yeah, so we did save our biggest part that we love sharing about, which is multifamily real estate investing. So it might seem a little bit intimidating to some people. So I go over some of the basics of what the jargon is and the talk behind multifamily investing is, net operating income, what is a cap rate, internal rate of returns, to help you be a little bit familiar with what multifamily investors use to analyze an apartment complex. As you might have heard, we've bought a few hundred units over the past few years here in Memphis, Tennessee, multifamily doors, and we just want to share a bit of what we've learned over these past few years and give you some quality education so you can then eventually move along with us into multifamily investing.
Definitely. Next up is going to be another speaker, Scott Saunders with API Exchange. And if you currently own real estate, he's going to teach you a strategy to pay less taxes, defer those taxes, and buy more real estate. The 1031 exchange is an incredible tool that you can utilize in the IRS tax code, and he's going to show you exactly how to do it, the pros, any hurdles, and what you need to do to be successful.
Now, personally, I am actually in a 1031 exchange right now looking for some properties, and I'm using Scott Saunders. His team is amazing. I highly suggest them if you're ever considering selling and building up into something bigger.
Yeah.
Then, lastly, we'll be going to a A-class neighborhood in Cordova on Thorncliffe, and we'll be diving into the before, during, and after of the renovation and drive through the neighborhood so you can get a feel of what an A-class neighborhood looks like over in Cordova, kind of the eastern pocket of Memphis, Tennessee. So we're super excited for this last and final day. Guys, let us know your questions and comments, what you're learning here. We love hearing everything that you guys are saying. It's really awesome. It's been really fun.
Happy Friday. Let's dive in.
Hey everyone, Sean Tagge here. I'm super thrilled and excited to be talking about multifamily real estate investing, according to yours truly, Sean Tagge, in my opinion, and my takes from investing in multifamily real estate. So, guys, I'm really excited to dive into this and help you see, just look under the hood of actually one of our deals that we've done and about to complete and sell and taken from start to finish on value add investing. And what I'm talking about here with multifamily, by definition, it's 5 units or more in one building or one area. And so it's different than single family. And what I'm generally talking about is about 80 to 200 doors, so larger multifamily deals. And I kind of give you the general take and gist of things. It's kind of according, and every market's different. This is according to us in Memphis, Tennessee, and our strategy of what we're doing. And I'll run you through some metrics of how to understand multifamily real estate investing, the jargon and lingo behind it, why it's so amazing. And yeah, it's just general trends. And as you know, things change. Like this could change from 2021. This is where it's at today. But multifamily investing is an ever changing organism going up and down with the real estate cycle. But I'll just give you some general trends and things like that to understand. So without further ado, we will dive into the presentation. All right. So multifamily real estate investing, according to Sean Tagge. And if this doesn't fire you up by the end of this show, by the end of this recording, I don't know what else will. All right. So first thing you need to understand with multifamily real estate investing is NOI. You're going to hear that brought up a lot. And that stands for net operating income. Okay. So it means your gross operating income minus your operating expenses. And operating expenses include all reasonable and necessary operating expenses to maintain the property and keep it operating. NOI does not include expenses such as your debt service. So it's before you're paying your principal and interest on your debt. It is before capital expenditures. What are capital expenditures? That's also called CapEx. It's abbreviated. Stands for like those big long-term ticket items on the repairs, like your roof, those will typically get depreciated over time on your P&L. HVACs, water heaters, big things that take a long time to rent out. But general maintenance and turnover and cosmetic repairs, that's included on your NOI. It's before depreciation, loans, amortization, and paying income taxes, your personal income taxes. NOI does include property taxes. It does not include income taxes. And the reason why we kind of standardize and use NOI as a general rule of thumb for evaluating multifamily properties is because it kind of standardizes and levels the bar before things get, gets crazy. So it's before debt service, meaning I don't know what someone's debt service is going to be on a property. They might put 25 or 30 or 50% down. They might have a 4% or a 5 or a 3% interest rate, a 20-year amortized or 30. So it's kind of unfair to analyze apples to apples because they're different once you get into debt service. Also before income taxes, I don't know if you're in a 20, 30, 40% tax bracket, and capital expenditures as well. So they're kind of wild cards because one year you might have $1 million in capital expenditures and then the next 5 years or 10, you have none. So you take that out because they're just such wild cards. So it kind of puts an evil playing ground to analyze one multifamily versus another. So that's why they use NOI. Here's an example P&L. And what I've done is this is summarized. NOI is based off annually, so per annum. And you can just go back on a T12. You'll hear that a lot too. So T12 stands for trailing 12 months profit and loss, NOI. And here's just a general one. You have your income up here, your rent, you have a vacancy and concessions minused out there, and also other income. That could be laundromat that you have on site or renting other parking spaces or other stuff like that. So there's your net income for this example property. Then you have expenses, taxes, insurance, lawn care, electric utilities payments, legal fees sometimes to evict tenants, management fees if you have a property manager, an on-site general admin property manager, maybe you might have some payroll, advertising, and then deposit and replacement reserves. That's just kind of saving up for CapEx and other things. Usually $100 to $250 a door is the industry standard to put that on the P&L. So it's basically your income minus expenses is your NOI, your bottom line here. Before you don't see a mortgage, your principal and interest, all those other things. So $565,943 in this example. So now that you have the NOI and understand what that is, you can then value the property based off a cap rate. So your cap rate, the equation is your NOI divided by the market value or asking price or whatever the market value is. So cap rate's a good way to let the owner know, kind of estimate what their first year return on investment would be if they purchased a property all cash, yet again, before debt service. So it's inversely proportional to value. So if someone asks you, would an asset be valued more at a 5 cap or a 10 cap? It's inversely proportional, meaning the lower the cap rate, the higher the value. So 5 cap has more value than a 10 cap. Okay, we'll go into that in a little bit. So and what it's kind of assuming is that a lower cap rate, investors are assuming a lower risk on the property. Thus, they'll permit to buy it with a lower projected return. What does that mean? An asset might be at a 5 cap per se. And that's let's say that's an A class because it's newer. It's in a better area, a better neighborhood, maybe higher paying tenants with better jobs. So an investor might buy that at a 5 cap, right? Based off the NOI, where a property in a C class neighborhood, I'll go over that, in a kind of a rougher neighborhood with not as good of schools, kind of blue collar tenants, they might think that's riskier because it's older, it's more unpredictable. They might want to have a better return, like buy it at a 7 cap, because they're assuming it's a little more riskier. So they want a higher risk reward ratio there. So that's kind of cap rates are kind of determining that as well, kind of investors' risk, other investors, what they're buying for in an area. Hopefully that helps you out. Okay, so going off here, you can use it to determine what the cap rate is. So let's say you have this T12 trailing 12 months. You take your NOI divided by market value. So here's your NOI, 565,934, and let's say you're gonna buy it or it's listed for 10 million. So you're like, what's the cap rate on that property? NOI divided by your asking price or purchase price, it's a 5.65 cap rate. You can type that in your calculator. So Now you know that cap rate. Well, you're like, well, is that good? Well, you need to know the market. You need to know what other investors are buying other similar assets for. Maybe other investors are buying assets in that area at a 5% cap rate or 5.25. So you're getting a little bit of a discount here for this property. Or other investors might be buying it at a 6 cap. So you're paying a little bit of a premium if it was in that case. And you can kind of consult with a broker or an experienced real estate investor or syndicator to kind of understand those cap rates. And it's always changing based off future projections, past trailing sales, and it's a moving organism. Cap rates can adjust up or down, quarter by quarter, year by year, month by month. Okay, depending on a lot of market conditions. We'll go over that. So you can use the cap rate to also determine the value of your property. Let's say you have 100 units, they rent for $800 a month rent, and you collect everything and nothing's vacant. So you have an income of $960,000 a year minus $460,000 in expenses for this asset. So you have an NOI of $500,000. And let's say you're ready to sell it and you're like, well, or you're just interested in what you might sell for. So what you might do is just go call a multifamily broker and just be like, hey, here's my asset. The NOI is 500. What's kind of the going cap rate? They'd be able to give you a better offering memorandum and estimate on that, but they might just say, yeah, the going cap rate's a 5. So you would be like, okay, well, what's the value? Take your NOI, 500,000 divided by your cap rate. So we're rewriting that formula to get the value. So 500,000 divided by 0.05. Cap rate's expressed as a percentage. So you got to put the decimals in front of it. And that's 10 million. So you'd be like, wow, it's worth 10 million, or theoretically I could sell it for that much. Now, does that mean it's going to sell for that? No, it's just generally what other assets have sold nearby. That's what it might sell for. They obviously differ depending on a lot of factors, but in general, you could get that, or maybe it might appraise for that if you're thinking of refinancing, and depending when and how much you bought it for, that might be good or bad. So that's how you kind of determine value from working backwards with your NOI and cap rate. So here's some examples. Your cap rate, it creates drastic changes to your return and value. So here, let me give you an example. So there's A, B, and C class assets and D as well. Let me kind of go over generally what an A, B, and C class multifamily asset means. So an A class asset would be in a pretty decent area, right? Like let's say a newer build, 2000 plus, 2010 plus built type of house, that'd be an A class asset, or in a better neighborhood or higher rents, meaning an investor's like, we will pay a premium for those properties at a lower cap rate because they're awesome. Or at least they assume that. They assume they're going to appreciate better or whatever. A B class asset would be 2010 to 80s or 90s build type of asset in decent shape, pretty good schools, pretty good neighborhood, pretty good income, rental income area, depending on city to city. And so investors are like, well, it's a little bit older. I'll pay a medium premium for that. And then some assets are C, and they're 1980s or 60s or older, or even older and in rougher shape, maybe in a generally rougher area. That'd be a C class type of asset. So it kind of goes by age mainly, but also you can kind of use those other factors in there, like downtown versus suburbial, things like that. So that's kind of what A, B, and C class assets are about there. All right, so back onto here. So let's say though you see 3 different properties on an A, B, and C class asset. Okay, but they all have the same exact net operating income of 100,000. So you would think, well, all 3 of them will sell for the exact same price. They all produce 100,000. No, the investment dollars differ because one of them might appreciate more. One of them might have less capital expenditures, newer roofs and stuff than another. So let's say one in the C class sells at a 10 cap. So 100,000 divided by 0.1 sells for 1 million. Another one might sell for 7.5 or 1.3 million at a 7.5 cap. Or another might sell at a 5 cap in that A class area for a 5% capped levered ratio of 2 million. So, this isn't how it is between A, B, and C. Like generally in Memphis, it's an A class is a 5 cap, a B class is a 6 to 6.5, a C class is a 6 to 7, 8 plus. There's D as well, 8 plus, 7 plus, and they're changing. Sometimes those deltas are razor thin. It might be 50 basis points, 0.5% of the cap rate difference between an A or B and C. Sometimes they're more spread out and they fluctuate and are always moving. That's why we use a lot of stats and data from other providers to kind of see where the market's going and use that in our projection models. So it is a real crazy difference between a 10 cap and a 5 cap, a double difference to the value. And they all have the same NOI. So every dollar increase to the NOI is a levered ratio in value. What do I mean by that? Every $1 you can increase on that NOI, whether increasing the income or decreasing the expenses, you can sell it for a levered ratio. Let's say at a 5 cap, you can sell it for $20 more for every $1 you bring to that bottom line of the NOI. If it's at a 7.5 cap, it's a 13.3, a 10 cap, a 1 to 10, kind of how we showed just there before. Then also on rents, every dollar in rent increase is even more levered because the NOI is based off per annum. So if let's say you can just raise $1 on one unit per month on the monthly rent, well that would give there's 12 months in a year, so that's $12 a year in NOI divided by a 5 cap. That gives you $240 increase to the value for just $1 on the rent. So it's not insignificant rent. Increasing rents $5 per unit per 100 units, right? It's a 1 to 12 lever on a 1 to 20 lever, or a 1 to 240 lever there, according to monthly rent. So in summary with that, NOI, rents, and cap rates really make or break your deals, especially when these are long-term buy and holds. What do I mean by that? Let's say you're projecting that you're going to hold on to the property for 5 years. So you say rents are going to increase 3% a year. Or what if you say 5% a year? That really changes, especially a 5% year over year growth. So you really need to know market demographics and where things are going and really project those. And then what I say also on this is really be conservative on that. Just because it's gone really well in the past doesn't mean it will forever. Or like also your exit cap rate. Let's say in 10 years, you're projecting the cap rate to be lower than what you bought it for. Or in 5 years. I mean, how do you know that? You can't predict what other investors are going to pay in 10 years. So that's why it's generally you want to increase a little bit, like 10, 25, 10 or 20 or 15 or 5 basis points per year on that cap rate. So if you buy a 5 cap, you might want to increase it to a 5.5 cap as your exit cap rate sell. Generally speaking, depending on, and sometimes if you have a value add, you might pay a premium because on the NOI, but because you're going to add so much value. Okay. So you just need to know a lot of market conditions, have a lot of expertise, and really consult with many professionals on this to really start estimating that cap rate and your exit sales, because that can really make or break your deal. I mean, if you're projecting 5% rents every year and you only hit 2, that could really be a terrible deal because you won't be able to exit it in 5 when that comes up in 5 years. Okay, so now let's go into some value add examples here. All right, let's say you purchase 100 doors for $100,000 a door, so for $10 million. Then you're planning on raising the rents by doing renovations. Let's say you want to put in $10,000 a door on the 100 units, so a $1 million renovation. And let's say your rents are currently $800 a month. You think they'll raise to $900 a month because you see 3 other complexes are renting for $900 a month, but they have these A, B, and C repairs on them. And you think you can achieve those repairs for $10,000 a month. So it sounds like a pretty good deal. Everything else to remain the same. So you'll get $100 a month rent increase for 12 months a year. Times 100 doors, you'll get $120,000 annual NOI increase. Divide that by your $1 million investment on the repairs. That's a 12% ROI. Now, obviously, this isn't factoring in what you bought it for, your down payment in it, skin in the game, but just a general gist from here. That's a great return. And this is before we're factoring in the value. This is just based on NOI. So if you factor in the NOI with the value, with the cap rate, let's say it's a 5 cap in this area, just theoretically, that would increase your value by 2.4 million, 120,000 times 20, $2.4 million. So your value goes from 10 million to 12.4, and you put a $1 million investment in, that is a 240% return on investment, 2.4 million divided by 1 million. So raising rents $100 a month added 120,000 to the NOI and an increase of 2.4 million to the value of the property. Sounds like a pretty good deal. Are you fired up yet? I am. So here are common ways to add value to a property. One is you can improve management on the property. So that's what me and my partners specialize in. We've bought several distressed properties, and a lot of it has to do with management and also the condition with Jim Reedy, Brad Reed, and Mark Hart. So you can improve the value by number one, just your property manager. They are the key. So what we usually do is get rid of the current property manager because they are not doing a good job. And we figure that out in the due diligence when they don't even respond to our calls or emails or have keys or are organized. So just simply screening tenants. What we mean by that is like making sure they have the income to more enough income to pay for the rent, that they have a good track record, a good background check. So, and that's setting that, not only does that set up the owners for success that you're going to get income, but really it's a disservice to the tenant if you put someone in that really can't afford it or it's stretching them too far. Also, having a good collections process, that's a great way to add value. If you can increase 1% better collection rate or 5%, that's awesome. And it's a lot easier on 100 units. A multifamily, because they're all right next to each other. You just, go knock on every door, talk to the tenants and have them, collect rent. Just talk to the tenant, be like, hey, you're late. What can we do to help you out? When are you expecting on paying? Just letting you know, we file an eviction if you're late by the 15th. So that can really optimize. It's a lot easier than driving to 100 single family doors all over town. Timely response on leads. So let's say someone wants to rent a multifamily property in your area and there's competition. So they're going to call 3 or 4 apartment complexes. I think the first person who answers that phone and answers the questions in a nice manner to that tenant, they're probably going to rent from that property manager. It's setting it off right. So that's what I mean by that. Just simple basics of customer service and also taking care of the tenants, answering their maintenance requests, being fair on both ends. The tenants, you expect them to keep their side of the bargain. Us as the owners keep our side by maintaining the property well. Lead generation and marketing. That's a great way to improve it because sometimes it's not occupied. Well, then you need to get more leads. To have it more occupied is the more people that apply might likely be able to get approved and get into the property. So you need to get your name out there. So branding the property as well is a huge one. Then policing the property, and especially the B and C class assets. Our on-site managers are out there picking up the trash, making their presence known, knowing all the tenants, knowing who shouldn't be there. Hey, are you on the lease? Well, why are you here? You need to be inside the tenant's property and not loitering on the property, if that's the case. Charging and fining tenants for littering. We have that fine on our properties and signs up for that sometimes. Picking up their dog droppings, right? Just things like that. Picking up twigs. Our property manager picking up some trash as they're walking around the units. Update the units and raise rents. So that's a big one we love to do, is just do a cosmetic. You should really focus your money on cosmetic, kitchen, baths, floors, grounds, and amenities. That's usually what gets you the best bang for your buck on reno to increase to NOI. So depending on the asset class, you could put in granite or backsplashes, or maybe just formica and a decent, clean, nice, safe place. Making the floors tenant and pet proof is really good because that saves you in the long run. So having those luxury vinyl plank floors or tile or marble, if it's even in a better class. Improving the grounds, that's simply just making sure there's no, gutters hanging off or bushes that need to be trimmed. Mowing the lawn. Amenities, you can sometimes just add a pool and you could charge a premium on the rent. More people will want to be there. More people will stay there longer and have it higher occupied. Sometimes you can add in a fitness center and charge a little bit for that. So it's convenient for the tenants, or covered parking. You can also raise rents up to market value. Sometimes it's simply just going in and changing the rent from $1,000 to $1,025 or $1,050. Some managers just don't keep up with the market rents. Yet again, improving management. Your property manager should be using the stats and data that you're providing them to know when and where and how to raise rents, and tracking how many leads they're getting and how quickly you're filling up the property. So that way you don't want to be always 100% occupied necessarily, because you might not be pushing the rents high enough. So you could charge pet fees and pet rent. In this day and age, a lot of people are living in apartments with a pet. Those are their kids. So maybe being, compliant with that, and maybe you could just charge a little premium. If you're the only one offering that to let pets allowed in your units, you could charge a little bit more. Covered parking or storage. Sometimes you could have storage units on the property, or build them in there, or build covered parking and charge a premium to park in that space, or have a storage unit. Other ways to add value is reducing expenses, as I mentioned. So you could do a utilities bill back, a RUBS, or pay to have them separately metered. So if it's not separately metered, all the water, electric, and gas bills might go to you as the owner. that could be a lot, 50 grand, 100 grand, depending on the property. You could go and bill that back to the tenants, just pro rata, it's 100 grand, put it back to all the tenants on them. Or you could add utilities onto the rent or get them separately metered so then the tenants just pay for it. And there's many ways to do that. And that's a great way to decrease your expenses. Negotiating contractor services. So what that entails is, let's say you have a lawn care company and that's your contractor for that. You could be like, hey, you can mow 2 of my lawns now, but I want a 10% discount. And that's a great way to add value immediately from just one simple negotiation or phone call. Economies of scale. I'll go over this in another example of a property, but you could have roving managers. Let's say you have not enough units, right, for one complex to justify having a whole on-site salaried person there per the, cost per the units, but you could have 2 units nearby and have the manager rove between both of them, manage both and split the salary pro rata. You can buy materials in bulk or have an on-site maintenance guy. So instead of paying another company and they're going to mark up that guy's salary 15, 20%, you pay it and skip the middleman there. There's government tax programs. So like a pilot, payment in lieu of taxes, or an opportunity zone. Also just plain and old simple tenant retention, good customer service. So there you go. Those are the common ways to add value to your multifamily real estate investing deals. Next definition and metric you need to know is your IRR. So people are going to mention this a lot, especially when you're thinking of, you are like a passive investor investing into a deal, whether that's, you can use IRR for a lot of things. It's typically used in syndications when you're investing in a syndication and they're splitting some returns with you as an investor. This is a great way to baseline, standardize like what type of return you'd make if you invested in deals A, B, or C, because each deal lasts a different type of time. Some might be a 2-year hold or a 5 or 7 or 10-year hold. And you can use IRR. It's better than ROI or average annual return because it factors in the time value of money. So the definition of IRR, or internal rate of return, is a metric used in financial analysis to estimate the profitability of potential investments. Here's the complex equation of the net present value. Don't worry, you don't need to look into that. Let me give you some layman's terms and show you how to do it. So IRR is a great way to compare multiple deals across each other because it factors in the time value of money, how long the deal takes, and when cash distributions or cash flow occurs. It's all about the time value of money. The cash flow you make in year 1 is more valuable than the cash flow you make in years 5, 10, or 10 or 3 or 7, whatever it may be. Because let's say you make $10,000. Let's say you put in $100,000 in an investment, like a syndication, where a guy's operating it and you're just a passive investor, or into a stock or into a business, whatever it may be. And you make $10,000 the first year. That's a 10% return. But then you make $10,000 the second year. That's a 10% return for the second, third, fourth. But the $10,000 in year 1, you can go and invest that in something else all the way through years. Let's say it's a 10-year hold. So that cash flow is worth more. It's more valuable. So it kind of factors in and gives you a higher IRR the earlier and quicker you get your money, and how much, of course, also how much, right? Like maybe I might be okay giving up no cash flow for 3 years, but I put in $100,000 and then I get $150,000 in 3 years, right? Sometimes there's a factor there as well, or in 5 or 10. So it kind of weighs in all of that on the net present value. So some theoretical IRR examples in real estate, and you'll get kind of different returns, but just kind of ways to add value. You could have a ground up build where you're not getting any cash flow. You put in $100 grand or $1 million, whatever it may be, into that deal. You're building the apartment, no cash flow there. It's renting up from 0 all the way up to 100% occupied. For a while, you're not going to be able to cover any expenses there. You may actually have negative, keep having to put money into that deal for a while until you sell it and get a big chunk of change, maybe. Same with value add stabilization. You might buy an asset that's kind of in distressed condition, get maybe a little cash flow or none for a year or 2, but then it gets great cash flow after you either refinance or sell it, and then a big chunk of change when you sell. Then there's also already stabilized and cash flowing multifamily, turnkey multifamily. That one, yeah, you get a good, maybe a decent return every year, but it takes longer to sell it because you need to let it appreciate over time, and you might not get quite as bit of a chunk of change at the end. So IRR can factor that in and compare which one is better according to the net present value of money. So let me dive into this for you. So here are some IRR examples, and I'm just going to kind of lay it down for you in simple terms. So let's say you buy a stock, and the stock at year zero, so the exact first day, it costs $50. So it's a negative. You're taking negative 50 out of your pocket into this deal. And year one, it gets you a dividend or cash flow of $5. And then year two, you sell it for $70. So you get your original capital of $50 plus $20 back in capital gains. So you have a 25% return on investment, $25 divided by $50. So that's a 50% ROI. Or your average annual return is 25% because 50 divided by 2 years. So, but look, your IRR on this deal is 23.43. And here's how you calculate it in Excel. It's really easy. Just click equals IRR and then the summation of these cells right here. Okay, your cash flow distributions or profit distributions. So that's kind of one. There's just an example there. Let's say though, comparing side by side, another deal, you invest $50 in, but this one you get cash flow really early, a lot, $20 the first year. Then though, you only sell it for $55. So this one you had the same ROI of 50% or 25% average annual return, but look, your IRR is 26.77, 3% better because you're getting cash flow earlier and you can then go invest that for that whole year. You can invest $15 more than this other deal. Okay. So that's why I like to use IRR, because a lot of people will be all fancy like, oh, we had a 200% return on equity multiple or 200% return on investment. Well, how many years did that take? When did you get cash flow distributions? Well, how much money did you put into it? Right? All of that stuff. Okay. So here's another example for you, kind of comparing three things across each other for you to understand a little bit more and see some more examples on IRR. Let's say you invest $100 into whatever. It may be a business, real estate syndication, a stock, something similar to that. At year zero, you invest $100 into it, and then you get cash flow, $10, $20, and $15. Then you sell it for $120. So you get your $100 initial investment back plus $20 return. You have a total profit of $65. So it's a 65% return. Your average annual return is 4 years divided by 65, 16.25. But your IRR, and there's the calculation again, is 15.78. So a little bit less than the average annual return. Then though, conversely, let's say there's another deal, but you get big cash flow the first year, then none, and then you sell it. This one, you get an 18% IRR. Let's say another deal, you don't get any cash flow and then sell it though for a good premium. You get a 13% IRR. Okay, so it's kind of factoring in the time value of money. And this, look, all three of these have the same profit, same ROI, same average annual return, but different IRRs. So it's factoring in that. And yet again, like, let's factor in though, like sometimes it's okay to risk no cash flow for a few years to get, you know, like let's say a big chunk of change in a few years. That's a 25 IRR, you know, anyways, and that didn't update, but you kind of get the gist here. It shows you it's factoring in and weighing in different time values of money. Okay, so back to the presentation. I'm glad you're able to, that helps you kind of understand IRR. So now we're going to use this, everything we've learned, kind of put it together a little bit and show you a real live case study value add. Okay, here is a property we bought, Waring Park Flats. Okay, back in 2019. It was over 2 buildings. So one building was 59 units we purchased in 3 of 2019. The other 40 units we bought in 6 of 2019. They are just a walk away from each other. And so yet again, that kind of showed we used the economies of scale, had one manager roving and managing both units and the economies of scale there, and enabled to help us sell it for a little bit more of a premium because people could buy them in bulk and economies of scale. We put in between both properties, 1.8 million in reno, a lot of exterior CapEx items need to be taken care of and interior renovations. Some of the units we even burnt down or in really rough shape. So our before rents were about $600 a month. And our after rents, we were able to raise our average rents across the 2 units to $750 a month. Some of them are renting for $825 right now. Some were renting for $750, but our average right now is about $750 a month. So $150 rent increases times 99 units, divide that by whatever the cap rate is, you can see the value there. Here's the big thing. This property before was occupied around 50%. So just terribly mismanaged, not occupied very well, and poor rents were way undervalued, and it was dilapidated. So now our current occupancy is at 98% with a 98% collection rate. So only a 4% economic vacancy. That's another thing you'll learn here about economic vacancy is, yeah, you can have an occupancy of 98%, but what if 0% of people are paying? That could be a 0% economic occupancy. Okay. So just showing you on the left is what I guess on your guys is right, maybe. Anyways, you'll see the before and after pictures. So we updated the sign and put in a nice fence around the unit, just made it look popping, looking awesome. A lot of exterior renovations. So before, the paint was all, wish-washed, and there was lots of rotten wood and gutters hanging down, and AC window units in the property, not very well maintained. So then we cleaned it up, and they're looking just really flashy right now over here. This was actually a good before unit. This is one of the best ones, these before pictures. Some of them were in way rougher shape, but there's before, and then after we're putting stainless steel appliances in, nice countertops, some nice fixtures and knobs on the things. We're not over renovating the property. Before we put in luxury vinyl plank, and we did a repaint, cosmetic repair, put in just a nice light fixture instead of fans. So we decided no fans because fans can break down. So we just put in lights in the rooms. So we kind of think about those things. Sorry, skipped one there. Here's the bathroom. Yet again, this is a really good before picture. We had some that are burnt down and really gross. And here's the after, just nice, clean, safe place. Okay, so here's kind of the strategy for our stabilization. First off, I want to go over this graph on the right. Look at the occupancy. It dipped the first couple months. People just saw that there's a new manager and they're like, oh no, I'm not paying rent and I'm just going to get out of here. And we got them out because we said either get out or you're getting evicted. Some just abandoned them where we had to evict them out. So we had a slow roll down, dip down to like 43%, but then we started bumping up slowly but surely, making ground. After 1 year, we're up to 75%, which was pretty decent because that was right around, after 1 year, actually about 8 months or so. And that was good because then that was actually our break even, meaning we were having an operational loss for a bit, paying the mortgage and the interest and all that until we got up to a certain occupancy rate, which was right around 65 or 70%. So then we're at least cash flowing. We're reinvesting the money to repair the units, the down units, and we renovated pretty much every unit on this property. And look, things go down a bit. You have some dips and ups. You sweat it a little bit, but you just kind of let it roll. This is real estate. And we just kind of started increasing the occupancy until now we were bumping up at 199%, 98, 97. And you can see we're trailing around 98% occupied. So that kind of is the story of this was a very heavy value add. There's light value add, which is basically going in and doing a $5,000 a door reno or 2 or 3 and just barely cleaning it and raising rents $50. This was a heavy where we put in a lot of money, but heavily increased the rents by $150 a door. So the big thing to the stabilization was new management. Reedy and Company Realtors, owned by Jim and Brad Reedy, a vertically integrated property management company. That was the key. We got rid of the old property manager. They were not doing well at the property, obviously, and the owners weren't investing in fixing it up. So we increased our tenant screening, our collections, we policed the property, and we definitely had market knowledge. Our property manager would meet with us weekly and give us updates and have a scorecard of what they're doing, how many applicants they're getting, how many tenant deposits, how many evictions they're having, what's their collection ratio. And we bring all of our other property managers together, which we have several around the city, and they all talk about what are their best practices and what they're doing to increase the revenue and decrease the expenses. And we have a regional manager, Billy Ross. He's amazing and coaches all of them. He's managed over 20,000 doors regionally before at another company. So we've brought him on in the recent years, and they do a great job, our property managers. They're amazing sheriffs, I guess also therapists / police officers. They are everything that the tenants need them to be. They are what Gotham needs them to be, right? They're kind of like Batman of the property, just making it better. That's the hugest part there. So real grateful for the team we have and everyone on this property. Ashley Morgan was the one heading off this property, and then she actually got transferred somewhere else. But our managers are amazing on this property. So then we had a renovation. That was a big thing. Is you want to not over renovate it. Like you don't want to put in granite counters, but you don't want to under renovate it either. So we kind of maximize that ROI to rent increase ratio. And we kind of run models on which one would work out the best on the repairs per unit to what we'll get to rent. And we also use a lot of data. We have internal data. So we actually had 2 other apartment complexes in the same zip code within a 3 to 5 minute drive. And so we could really test out rents in those ones. And what's also nice there with the economies of scale is if a tenant doesn't want to rent this apartment because the square footage is too big, we actually have other units that have smaller square footage and vice versa. So they're all helping each other out. So, and then also speed. We didn't want to renovate it. Like we don't want to go renovate all 50 units that are vacant. We only want to renovate as we can lease them with the saturation. So we renovate 5-10 units at a time. So that way we can move people in. So we don't want to renovate all 50 because then all of our capital's poured into the property and we're getting charged interest on that for a while. So, and then of course, economies of scale, because we're renovating hundreds of units a year, we can have on-staff people and buy materials in bulk. So yeah, in summary on this property, we raise the rents on average $150 a month, roughly per each unit. So the before NOI was roughly $86,100. The after NOI, according to our T6, oh yeah, let me go over that. So T6 stands for trailing 6 months annualized. So we just got the T6 and times it by 2 to annualize it. And the reason why we didn't use a T12 or 12-month trailing is we were still stabilizing and it's still even past 6 months, still a little bit being stabilized. So you can't really count when it's 80, 85, 90% occupied. But now that it's been 90% plus occupied, these T6 months, we can use that for the NOI to kind of sell it. Sometimes they'll use a T3 or T2 or T1 even and annualize it to kind of go off that NOI and projecting what it is. So a T6 of $550,368. So that's an NOI increase of $464,268. Pretty dang good work. If you divided that by a 6.5 cap, that would be a 7.1 million increase in value. Now the real value increase was 4.65 million. And let me explain why. We didn't buy it at a 6.5 cap based off 86,000. We bought it for 3.4 million, which actually equates to about a 2.3% cap rate. I know some of you guys are like, whoa, Sean, are you crazy? A 2.3 cap rate, that's less than what cap rates are in New York City. Like New York City, they're at like 4, maybe high 3s sometimes I've heard. So this is lower than that, meaning more or less risk. This was the riskiest deal. Well, yes, guys, it was a riskier deal, right? This isn't stabilized day one cash flowing. But the seller's not going to sell. The land and the building value is worth more than what it is at a 2.3 cap of that NOI. It's just a super distressed value. So that's why, yet again, you got to really understand the market, really understand the numbers and all the case studies and scenarios, really have good projections and know your numbers. We've done this over several other doors, over 1,000 doors, my partnership, Jim Reedy, Brad Reedy, Mark Hart, Jay Reedy of Southern States Apartment Group. So we've operated this and know this and have been around this a few times. So that's why we felt confident buying something at a 2.3 cap. You would think it's crazy, but it worked out. It's worked out very well for us on all of our other units. And so the real value increase was 4.65 million. Obviously we have a lot of expenses and interest and other things going on there and all that. So our total projected IRR on this deal was, first, let me explain one other thing about IRR for you. Okay. Is you don't really know the true IRR until you sell and after it's sold and closed, because that's when you get all of your original capital back and your big proceed when you sell. So it's really, you can really only project it until day whatever that you sell it. Before that, it's just a projection. That is a con to IRR, where with average annual return, you can get your average annual return just divided by the year or pro rata of what the year is. So let me show you what I mean by that. We haven't sold it yet. So we haven't gotten our, let's say we put in $100 original capital. So look, it breaks the IRR. The IRR is negative until we know what we sold it for and what the capital proceeds were, right? Any of these that you don't have when you sold it, then I can only project it, right? So I don't know the exact IRR because it's projected. Like I could sell for one, I can project pretty close because we're pretty close to closing. It's under contract and ready to sell, so it's 21.96, dollars, and boom, I can have a projected IRR, but you don't really know until you sell it. So in all fairness, guys, I'm not going to let you know what the projected IRR is until it's been hatched, right? We're not going to count our chickens till the eggs hatch here, but I have the projection, and I'm telling you, it is up there. It is going to blow you away of what the IRR in this deal. Now, do I believe every single one of our deals will be like this? No, we got really lucky. We were in the right place at the right time, doing the right things in this right market cycle from 2019 to 2020. Go look at multifamily values in Memphis over the past 2 years. I mean, in any market, you look like a genius, right? With all that what you're getting. But what we're going to do as a special treat to everyone watching this, we're going to leave this IRR blank here, not disclose what that is until we've sold it. After we've sold it, I need to hear from you guys in the comments, and I need to hear you guys subscribing on our YouTube channel, liking our videos, giving us some love, giving us some comments. What's the IRR, Sean? And we'll tell you what the real IRR is when it closes. It should close sometime this month in July if everything goes well. I mean, it is past due diligence for the buyer and everything like that. Okay? Sound fair enough? Thank you, guys. So anyways, this is multifamily investing. And if that didn't fire you up, I really don't know what else will. I've given my all right now for you guys to see where we're at and everything like that. So thank you so much for attending our SOFA Summit 2021 on how to become a cash flow king. Have a good one, guys. Appreciate it.
Well, guys, you might be seeing this Yeti hanging out right here. And so what we're doing is we're going to give away a few Yetis to some lucky individuals.
3 lucky individuals. And there's 3 different ways to win the Yeti. The first one is, you've already done it, is just register and attend the actual event. Then the second way to win the Yeti is to subscribe to our YouTube channel. And the third way to win a Yeti is to be interactive and have the best comment in the little chat bar.
Yep, so be commenting. Let us know your thoughts, comment, or question. We will consider on helping you win that Yeti. So thank you so much, guys, and we appreciate you being here.
Welcome, everybody. Mark Hart here from Memphis Investment Properties, and I have a really incredible guest speaker today for the show. The topic is going to be 1031 exchanges. And from a high-level perspective, you got to ask yourself the question, if you like paying taxes on the profits of your real estate portfolio, then this show and interview is not for you. But if you want to find a way to not pay taxes, to keep more of your profit so you can scale your real estate portfolio and ultimately get more passive income, then you need to meet my friend, Scott Saunders. Scott, welcome. How are you doing today?
Hey, Mark, I'm doing great. Great to be with you. And I really love talking about this topic. And it's just a pleasure to be with Memphis Investment Properties and you, and being able to chat about the benefits of a 1031 exchange and what the mechanics are and how they're such just a powerful tool for investors to grow their portfolio and build their cash flow, build their wealth.
Yeah, well said. It definitely is a very powerful tool. So for those that don't know, the beginners out there, what the heck is a 1031 exchange?
Great question, Mark. It's really simple. When you hear the word a 1031 exchange, it goes back to something called Section 1031 of the tax code. So the tax code has all these numbers for different sections. This section deals with property that's held for investment. And it says if you take any property you're holding for investment, and instead of selling it, you exchange it, and we'll talk more about that, you can defer paying all capital gain taxes. So the big benefit to an investor is you get to take all that equity that you built up and all of that gain, and you get to redeploy it into better performing properties rather than having to pay Uncle Sam off the top and then take your net equity after tax. You get all the gross equity working for you in another piece of property, or properties, right? You can go, you've seen that all the time where people sell one larger property and they buy multiple smaller properties and really bump up their cash flow.
Yeah, I mean, one of the big things that we're definitely seeing right now is, right, a lot of California investors that have been holding on to their properties for many, many years now. They've achieved incredible appreciation and equity, and then they're being able to work with you, do a 1031 exchange and buy multiple properties and really increase their cash flow and really increase, double or triple their passive income, which is, ultimately why we're all here. So we're, definitely going to dive more into that. But why don't you just tell us more about yourself, Scott? What's your background? What's your history? How long you been in
Thanks, Mark.
1031s?
I've been doing 1031s. I had hair when I started doing 1031s. Not really, but I probably had a little fuzzy things on the side. I started doing this way back in 1988, before we even got guidance from the IRS on how to do it. So I kind of stumbled into the whole industry when it was just growing. And this is all I've done, our 1031 exchanges. I started out, you mentioned California. So I was out in the California Bay Area, and that's where I started. I now live in Colorado, a little bit south of Denver, and do exchanges all around the country. So, kind of like what you said, I certainly see some of the trends where people are deploying out of the West Coast, right? California, Oregon, Washington, and they are shocked with the returns they can get when they go to a Midwest market like Memphis, and they look at that and they go, wow, they take all that equity, which is really amazing what's happened on the West Coast, but there's not a whole lot of cash flow. And then you take that and you go to a market like Memphis and you go, wow, there's a whole lot more cash flows can be coming in off of that exact same equity when it's redeployed out there.
Definitely. I mean, we're seeing investors that are selling a property for 500,000, 600,000 in California, but it's only renting for $2,000 a month, if that. And then they can, work with you, sell that property, and then go buy multiple, 6 properties that are all coming in at around $6,000 a month in rent, which is just absolutely incredible that they can double or triple their rent using the same amount of capital, which is great. So you're working with asset preservation. Why don't you tell us more about API?
Yeah, thanks. So asset preservation is been around for over 30 years. We're a leading national qualified intermediary. In fact, the headquarters is out in California. We've got an office out in New York, and we're a subsidiary of Stewart Title. So we've got a larger title insurance company that's our parent, which is great from a security standpoint, right? It's nice to have a company that's tied in with a larger parent organization that provides some of those internal controls and financial backing. So we act as what's called a qualified intermediary, which if you know nothing about exchanges, that's a weird term, right? A qualified intermediary. We're that middle man, that middle company that prepares some of the paperwork to set up an exchange that's needed. We hold the funds and then we prepare paperwork to purchase replacement property, depending on where you are. And I imagine your audience is national. You mentioned California. In the West Coast, you'll hear us called an accommodator or facilitator, sometimes an intermediary, sometimes a QI. The IRS calls us a qualified intermediary, but all of those terms define what asset preservation is that middleman company that helps put everything all together in a 1031 exchange.
Wow. So since you've been doing this for this long, how many 1031s do you think you've completed in your career?
Oh,
That's
lots
a tough
and lots.
question.
Yeah. If I were to tell you, honestly, it's well north of 100,000. So
100,000,
100.
and that's not sales volume or equity. That's just the number of transactions you've completed.
Yeah. Yeah.
Wow.
Well north of that. Well north of that.
And you only need to do it 10,000 times to be an expert. So you're definitely, you know what you're doing. That's wonderful. So sounds like you guys got a great process that's very streamlined, with API.
Yeah, we try to make the process very user friendly, kind of like you started off. A lot of people maybe haven't done a 1031 exchange. They've got 1 or 2 rental properties, they've gone up in value, and then they hear about this as a tool. So your choice is either pay a whole lot in taxes, or if you're going to go ahead and reinvest, look at a 1031 exchange and boosting your returns. So We try to walk people through the whole process. When somebody calls us, we'll ask some initial, we kind of call them intake questions, get an idea of how they hold title, what's their equity, what's their debt, how long have they held the property. And then we try and explain the rules, kind of what we'll talk about today. What are the time deadlines? How do you do an exchange? So a really good qualified intermediary is going to kind of hold your hand through a transaction. So
Hmm.
you're not just out there trying to stumble around and figure it all out, but as you set it up, there'll be some initial questions and then guidance. When you close, there'll be some additional guidance on kind of what the time deadlines are. And then when you start to purchase property, same thing there. So we're really involved all the way through the process with the investor.
And so, these are it's such an incredible tool, right? Just to even have the 1031 exchange. But now moving forward, not to get too political with everyone here, we have seen the current administration. I've, heard a few little birdies out there, that have brought up they may get rid of 1031 exchange. I know you're heavily plugged into that scene there. Can you tell us more about that and what you've heard?
Yeah, Mark, I'd be happy to do that. First of all, when you talk about an incredible tool, let me kind of just start there. This has been in the tax code since 1921. So we're literally on the 100th anniversary of 1031 exchanges. So it's been used by people for a long, long time through economic downturns, from times when things are booming and everything in between. And the types of investors are so broad, right? It could be a rancher or a farmer owner. It could be somebody who owns a business. Maybe they have a shop. It could be the small investor. It could be the large investor and everything in between. So just, from the beginning, 1031s are a powerful tax strategy that help investors of all sizes. So you mentioned that there have been some, rumblings. What happened, and I'll give you a little of the backstory, is when people run for president, they come out with tax plans. And all politicians do. Here's our idea on this side or that side. And I want to make really clear to your audience, this isn't a partisan issue. So there have been different administrations, Republicans and Democrats, that have seen 1031 and maybe not understood the value and said, well, maybe we can have it go away and get that additional revenue coming into the IRS to fund other programs. So
Hmm.
throughout the years, we've seen that. With the Biden administration, he came out with a tax proposal of a bunch of ideas that he had if he was elected president. And one of those touched upon 1031 exchanges in his proposed tax plan as a candidate. And so keep in mind, when you run for office, you throw out all sorts of ideas and they probably have a bent towards your perspective. Then when you get into office, now you've got to work together, right? You've got to work with senators and people in Congress, in interest groups and lobby, and then what's practical and what's realistic. So in my opinion, sometimes when you come out with a proposal, it's a little more big, it's a little more broad. And
Hmm.
when you get into office, now you've got to work through the real world. And maybe what you craft is something that maybe isn't quite as large as you proposed. It's going to be a little bit more narrow. In the proposal, President Biden had talked about 1031 exchanges, and his proposal was potentially eliminating them to pay for some new spending programs on childcare and elder care. A pretty significant spending program. The price tag was about $775 billion. So we're not talking something that's really small. It's a big new
Hmm.
program.
Yeah, definitely. So then I feel like that is one thing to where, because of what he said, we've seen this massive boom. At least we feel it over here with clients coming to us almost daily saying, oh, I'm afraid 1031s are going to go away. And who can I talk to? I need to find someone like you, Scott. So let's just assume, theoretically speaking, that if they did go away and you couldn't do a 1031 exchange, what type of taxes would the investor be exposed to?
Great question there. The taxes are really fourfold. So we get this question probably like you do, which is, well, what is the capital gain tax, right? Almost in a singular form. What's the tax? And I have to go back and say it's a little more nuanced than that. So I'll break it down into four different components. If you're going to have to sell and pay taxes, you'll have to pay taxes on the depreciation recapture. That's at a
Mhm.
rate at 25%. The remaining federal gain is taxed at either 15% or 20%, depending upon your taxable income. Next up, you're going to have state taxes. So you're fortunate there in Memphis. You don't have state taxes. You're one of the states. Florida does, and
Woo,
Texas. And it's no surprise why all the businesses are and people are starting to flock to states with no state tax. On the other side, you have states like California. Their top tax rate is 13.3%. And I will tell you, as of today, we're doing this right now at the end of February. There are a lot of states that are proposing bumping up their taxes because of the COVID and the pandemic, and their revenues went down. So they're looking at ways to boost revenues. So I don't think California, that 13.3 is going to be such the outlier. There are a lot of proposals. Last tax that's kind of sneaks up is something called the net investment income tax, which is kind of a mouthful, but it was put into the code about 10 years ago. And it's an additional 3.8% tax on what we call net investment income. That includes capital gain. So the threshold is if you're a single filer, any net investment income over 200,000 would face that tax. If you're married, it's over 250,000. So net, when you talk about the tax, you got to add up to the depreciation recapture, federal, state taxes when they apply, and the net investment income tax. What I find is that a lot of investors, when they add all those up, they're shocked at the amount of their profit, right? Their money that they think they're going to earn, that they're going to have to give over to Uncle Sam. And that's really what kind of stimulates the whole discussion on 1031 is looking at that tax bill and going, wow, I've had a property for 15 years and it's been a lot of work and I made a few bucks, but I'm gonna have to turn over all that money to the government on my gain.
Yeah, it definitely can be really shocking. And, me personally, I'm not a CPA or tax attorney. And so we do have referrals for you out there. My personal CPA, basically, if you hold real estate, we really strongly advise that you do have, a CPA and a tax attorney to kind of really get granular with it and see how these taxes will or won't affect you. And if you would like that referral, please just reach out. My contact information will be, below. So then, let's say you are, brand new to the 1031 exchange and you're interested in actually moving forward, right? You've got a property, it's appreciated very well. And now you want to perform a 1031 exchange. What's the first step that an investor should take?
Well, you actually kind of alluded to it. I would recommend the first step you do is call your CPA or tax advisor and first find out what would I pay in taxes. So I think that's a good starting point, is just to get that data and find out what you're up against. That's the first step. The next step would be you can set up a 1031 exchange officially once you've got a buyer for your property. So you have to have a property that is held for investment that now is under contract and you've got a buyer for it. You've opened it up with your local closer or title company. That's the point in time when you can begin moving forward with an exchange. After that, what you need is, and this is a really important step, and unfortunately we run into dozens of people every month that fail to do this. If you want to set up a 1031 exchange, really important is contacting a qualified intermediary, getting them in place before you close. I can't tell you how many
right?
times.
Keyword before. Exactly. That's the big one, everyone. The most important thing you got to know, if you want to get it done, contact Scott or a qualified intermediary before you close and sell your current property. That's it.
Well done. So critical. It probably comes up multiple times a week where I talk to somebody who wanted to do an exchange and they closed a few days earlier, a week ago, and they just heard about it. So if you're a first-time investor and you're considering this, make sure that you put the 1031 exchange, you get it set up before you close. And even if you don't end up buying, let's just say you set up an exchange and it doesn't work out, you don't find anything. The costs are relatively nominal to do it. The average qualified intermediary, the fees somewhere around $1,000. It could be 900, it could be 1,200, but let's say around $1,000. It's not a percentage of your price like a real estate agent. So that's your fee to potentially set it up. And then you've got a certain amount of time to look for property. If it doesn't work out, that's really all you're out. But at least it gave you a chance to defer all those taxes.
Wow, and that's incredible to see. Like you said, it's not based on the percentage of the value of the subject property that you're trying to sell. It's just a fixed cost. So we definitely recommend. It's always worth a conversation, right? Just to see if it's something that you want to do. So then let's go more. So let's continue with this process here, of completing a 1031 exchange. So let's say you own the property and now you have it under contract to sell, and then we contact you. So then now tell us more about the time constraints that you're going to face going into a 1031 exchange.
Sure. So what will happen is you contact a qualified intermediary. What they will need is a copy of your contract, and they'll need the information for the closer who's handling it. They're going to prepare some exchange documents, and I won't go through all of them, but the main thing is they're going to prepare an assignment agreement to assign that investor's right to sell the property to the qualified intermediary. So we technically, an intermediary, we step into the shoes and we become the seller of the property. We sell the property to the buyer. So when the closing happens, that's what we call day zero of a delayed exchange. So it closes, that's day zero. Then it's a really important time deadline is you have 45 calendar days till midnight of the 45th day to what we call identify property. So that's called the identification period. So closing date zero, 45 days to identify. Then you've got an additional 135 days after that to close on one of the identified properties. So you've got a really limited time windows, particularly in today's market. You see that where things turn over so quickly. You've got a limited time window to identify specific properties.
Yeah, that's really good for everyone to know, right? There's that 45-day window when you have to identify. And identify, at a fundamental level really just means write down the address and give it to Scott, right? You don't have to actually close on the property. But also tell us more about, what types of properties that you cannot do in a 1031 exchange. Like, what does a like kind property even mean?
Yeah, I'd be happy to do that. And hey, by the way, Mark, I just want to commend you and Memphis Investment Properties for doing that for investors. The biggest complaint we have is people saying, I don't know what I can buy in the market. Things turn over so quickly. So you making a commitment to 1031 exchange investors, giving them a look-see, a little time window ahead is just, it's a huge benefit. That is the biggest stressor that we have in the marketplace. So kudos to you guys for doing that. I can tell you it is so much appreciated by 1031 investors.
Yeah.
I'll switch gears on you. Like kind. This is one where there are a lot of misconceptions of kind of what is like kind property and then what doesn't qualify. So let me just take what does qualify is any property you hold for investment. So as long as you hold it for investment purposes, it can be exchanged for any other property held for investment or used in a business. So raw land is held for appreciation. There's no income. You could exchange that right into a rental home in Memphis.
Mhm.
You can exchange for all sorts of different types of assets. It could be an apartment building. It could be commercial, industrial, retail, duplex, fourplex, even a vacation home, if it's held for investment, meeting certain requirements can qualify. So like kind is broad. I was just talking to somebody in Congress this morning, and they didn't know you can do an exchange on a conservation easement, on water rights, on air rights, on cell towers. So like kind is really, really broad. Now you had a question, which is what doesn't qualify. Super easy to keep that in mind. So number one would be your primary residence. You can't exchange out of an investment property and then go into a property you're going to live in. So it's got to be held for investment. So that's excluded. The other one is a little bit more interesting. It's any property where the intent is to hold for sale purposes, what we call dealer property. And where this comes up a lot, particularly in today's market where things are so frothy in some areas. Somebody can buy a property at one number, let's say for 200,000, and they could throw a little paint on it and fix it up and sell it for 280,000 a few weeks later in some places.
Mm-hmm.
If that property, even if you make a profit on it, but if it isn't held for investment, i.e. rental income, it doesn't qualify. And so sometimes we get that question, well, I made money on it. How come I can't do an exchange? And it's really simple. The code just says, if the intent is to hold for sale purposes, not long-term investment, i.e. rental income, you can't do a 1031 exchange. It's excluded.
What's the time frame there in terms of what a long-term investment actually means? Does that mean what if you hold it for just a year and then sell?
Great question. There's a lot of misunderstanding. There's a lot of misunderstanding, Mark. So I appreciate you queuing me up for that one. So let me tell you right off the bat, there is no time period. And you might even hear from people locally, you got to hold it for a year or a year and a day or 18 months or 2 years. There's nowhere in the 1031 code where it says that there's a specific time period. It just says that your intent must be to hold for investment. So where it gets tricky is, look at my intent. My intent's up in my head, right?
Right.
So what is the IRS going to look at? They're going to look at your unique facts and circumstances. So the time period is important, but it's just one aspect of a whole bunch of things that they might look at in an exchange. So I know that's kind of it almost sounds like a fuzzy answer. Many CPAs and attorneys would say, if you want to be conservative, holding it for a year or more is relatively conservative. I would tell you from a more nuanced perspective, there are tax court decisions where people have held for less than that have held up because they were able to establish that their primary intent was holding for investment. So probably, as you mentioned a little while back, it's a good one to check with your tax advisor and your CPA. Look at your unique facts and circumstances, and maybe even a little bit, not only your situation, but also, your CPA and tax advisor's perspective. Do they tend to be more conservative or more aggressive? There are different perspectives out there, and it's just good to review that with your advisor to find out where they land on that.
Definitely. So we talked about what you can't, do a 1031 into. Well, what about apartment syndications? Are you able to do a 1031 into and out of an apartment syndication, like a traditional GP, LP type of split there?
Yeah, we get that question a lot. The short answer is no. And the reason is, in a typical syndication, you're going to have a general partner and a bunch of limited partners, could be in an LLC, but the same concept. The IRS has said specifically, you cannot do an exchange on a partnership interest or a member interest. It's excluded. And the reason is pretty simple. The partnership, and that's the syndication, let's call it, that owns real property. But if I have an interest in a partnership interest, that's a personal property interest in an entity that owns real property.
Mm-hmm.
So at the end of the day, you have to do an exchange on a real property interest, not personal property. And we get this a lot. So it's specifically excluded from the code. You cannot exchange out of a syndication. You can't exchange into a syndication. Now, with that being said, there are some ways that if you're in a syndication and some of the people would like to exchange out, there are some strategies to maybe approach that. Or, and I'm sure you've seen this, Mark, sometimes in a syndication, if you've got just a few partners, maybe the whole partnership says, hey, we like to, as a partnership, keep intact. We'll sell this asset. We'll go buy a new asset in the same partnership. So partnerships, LLCs, if they stay intact, can do exchanges. Any entity can do an exchange, a trust, an S Corp, a C Corp, an individual. It just gets a little dicier now when you've got people in a syndication and some want to just cash out and others would like to move forward in a 1031 exchange.
Exactly. It sounds like you have to have, a team effort. If everyone's on board, then you can, 1031 out of it. But if not, if some people have, polarizing opinions and want to go their own ways, then you probably cannot. Then you definitely cannot. Hey, so let's say, it definitely sounds like you're an expert. We know that for a fact, a lot about 1031s here. So, for everyone out there, if they're interested in just learning more, and getting in contact with you, how would they go about that?
Easiest way, well, a couple ways to get in contact with me. One would be my phone number, which is a really easy one to remember, Mark. It's 888-531-1031. So that should be an easy one to remember. My email is scott@apiexchange.com. And then finally, our company website is API Exchange. So it's A as in Apple, P as in Paul, I as in Igloo, and the word exchange.com. And by the way, there's a lot of information on that website. So we've got YouTube videos, just like we're doing here. We've got information for those of you that are a little more sophisticated and have advanced questions. We've got advanced information. We've even got a calculator, which is just a great tool for maybe a first-time investor, where you can plug in your numbers. We call it our capital gain tax calculator. And then you can see what you're going to pay in taxes. And then you can see, if you do an exchange, how much more property could you buy? And if you don't, what that would look like. So there's some great tools on there that we try to make available to real estate investors who haven't done this, so they can kind of get a feel for the process and maybe look at their situation and see what the numbers might look like.
Yeah, it truly is incredible what you guys are able to, accomplish and help out with investors all across the board. So also, you guys can reach out to me. Happy to give you Scott's contact information. We'll put this in the comment section below in the description, for the video. So hope you guys like this interview. Please make sure you subscribe to our YouTube channel. We'll continue to be having these incredible interviews and get some of the best experts in real estate investing here on the show. So that's it for today. Thank you all, and happy Friday. Hey everybody, Mark Hart and Sean Tagge here from Memphis Investment Properties and Reading Company Realtors, and we are thrilled because we just closed on a 184 unit apartment building here in Memphis, Tennessee. Woohoo!
Oh yeah, looking great.
So it's a beautiful summer day, it's an active job site, we're hitting the ground running with renovations, but we wanted to share a little bit more of the details with this project. This first step that we're going to accomplish here is going to let everyone know that there's a new owner in town and a new property manager. We want to complete a full rebrand on the asset. So the first step is to change the name of the property, and we've chosen Graceland Point Apartments. We decided to pick Graceland because we're located here in Whitehaven, Tennessee, which is where Graceland, or the king himself, Elvis Presley, is originally from. Then we also chose Point because that is the brand that we've created with some of our similar assets here in the submarket, to where if there aren't any available units at some of our other properties, well then when we can refer them to this asset, and the tenant is going to know the high level of renovations and care that we take on our assets here. Then the next part of the rebrand is going to be letting everyone know that there's a new property manager in town. We'll do that by hoisting flags on the main road, putting up signs, putting up flyers, giving a notification to every single one of the tenants. We just want to let everyone know that there's a new owner in town, and we actually care about our tenants, and we're here to provide a clean and a safe place for people to live, and the goal is to stay an extremely long period of time.
Yeah, awesome. So with any asset that we buy, especially on the multifamily side, we have four main objectives. So our first objective is, as Warren Buffett says, his three main rules of investing is don't lose money, don't lose money, don't lose money. So capital preservation is a big deal for us. How we do that and mitigate that risk of losing our capital, our investment we put into this, is first getting insurance on the property, title insurance, checking, making sure all those things are right. And all those things that are out of our control, like acts of God or storms, we're covered because we have insurance. That mitigates a lot down of losing all of your money. And of course also is that we try to maintain control of the property management. Reedy and Company Realtors will be managing this. That's that's managed in-house, so it's vertically integrated top to bottom. So we can watch over the property manager and make sure we're just doing all the basics. Making houses for rent, making sure they're turned in a timely manner, collecting rent, following up with tenants, answering the tenant phone calls. Pretty easy stuff, but that really helps you preserve your capital. So our second objective is income, right? You want cash flow on all your real estate. So how we're gonna do that is by producing a really great renovation on this property. That is going to increase our income on the property, and then also decreasing our expenses. By having in-house property management, we can reduce a lot of maintenance calls with this renovation we're doing on the property, and many other strategies that we're going to put in play. Okay, so our third objective is tax efficiency. As you know, real estate investing has a lot of tax advantages, a lot of great tax write-offs for us as investors. The big thing is this renovation. Yeah, we're investing that into the deal, but we can actually write off most of the renovations year one according to bonus depreciation that's in effect. So a lot of the money we're making, we don't have to pay taxes on, and can actually defer them for years to come, or take them right now depending on our scenario. So tax advantages is also another huge one. Fourthly is we want capital gains, right? We want to increase our net worth and the value of this asset. That's done through, we're going to be raising rents roughly around $100 a door. So 184 units, that's raising rents around $18,400 a month, or $220,000 a year. Dividing that by a 7 cap in increased net operating income, the value of this property will go up by around $3.1 million over the course of this deal, just in the raising the rents alone, and that's not including several other things we're doing. So that'll help us, you know, get a great return on our money and everything like that. So we're going to be diving into other segments of this property, what we're doing, and all the details in between. So yeah, let's go jump on in.
All right.
Thank you.
Hey there, I'm Jim Reedy with Memphis Investment Properties. We're down at our newest apartment purchase, the Graceland Point Apartments. We closed on June the 1st on this property. We started working on it June the 2nd. We do a lot of infrastructure stuff first. We came in and jetted out all the sewer lines, dug up a couple. You got to do that before you start doing your parking lot, this, that, and the other. We started roofing the buildings. We're putting a 30-year black roof to go with our new colors, which is gray with white and black trim. So the good color that we picked out and used before, it really goes well. It's old faded out brick. It's really not the kind of look that we're looking for. Another thing that we do in the beginning, we cut pine trees. All the trees, trim them up. Some of them we're cutting down. As we're roofing, we're replacing a lot of decking. We had a lot of bad decking, cornice work, facial work, and then we're finishing up with the 30-year roof. There'll be new gutters put up here, new rails. A lot of concrete walkways have to be dug up, repoured. About 80% of the walkways have to be redone. There's fencing to be installed. All this exterior work on this property will take about 4 to 6 months. On the interior side, we're working on about 10 right now. We've got 30 vacant properties. We see that dipping down to about 50 to 60 in the next 60 days. We like to come in and get rid of tenants that are not paying and get to the bottom and out point. We're about 80% occupied. I do see that going down to 60% in the next few months. Got a real strong manager and assistant manager here. We've got a lot of experience working in Whitehaven. We feel real strong that we've got the right people in position here. We've got 2 maintenance men already hired for this property. Right now we got about 20 or 30 subbed out guys doing the roof, the painting, the sewer work, this, that, and the other. So we're really excited about this property. We've done a lot in this area. We know where our rents are going. We feel like we can be where we want to be rent-wise in about a year. A lot of people down here are paying real cheap rent. So We're coming in and making a quick change with all this and that. We got a full-time groundsman down here, and it's a full-time job. We've already handed out letters to the tenants, letting them know there'll be a $50 per month chargeback if they keep littering down here. So we're coming down here not only renovating the property, we're trying to renovate and teach our tenants the way that we expect from a management company to pay the rent on time, keep the property in great condition. There's a lot of deferred maintenance here that our techs are doing. A lot of people have not had adequate heat and air in the last few months, a lot of plumbing issues, as well as electrical issues. So we do that in the very, very beginning to keep our tenants satisfied and keep them, give them what they pay us to do, manage the property correctly and give them good services. So again, we're really excited about this. This is overall be about an 18-month rehab, getting people out. If it was vacant, I could do it in a year, but we have to give people notice to move. We have to honor their lease dates. But it's about an 18-month renovation to get to where we want to be.
All right, day one, when we closed on this property and took over ownership and management of the assets, we found out that there were 40 unresponded to maintenance tickets from the current tenants. They've been waiting for multiple weeks and months to get their small maintenance items resolved, but the previous owners just didn't care at all. So we decided to jump on that as quickly as possible. The most common issue that we found were leaks, whether that's plumbing leaks inside the bathrooms, whether it's the actual vanities, the toilets, or the showers, or there's a lot of major roof leaks just because the roofs here are absolutely destroyed. And so what we're focusing on is getting all of those maintenance tickets resolved, and actually just found out that we were able to fix every single one of those issues within 7 days. And now moving forward, we're able to get to these maintenance ticket issues within 24 hours, which is just making the tenants as happy as humanly possible. And which is making the tenants extremely happy. So much so that one of the tenants actually came in and gave our on-site property manager a hug because she's been waiting months for the issue to be resolved. So moving forward, we're here to reduce the expenses by fixing all of these plumbing issues, right? There's a lot of leaking water which can increase our utility bills. So if we can go in and fix those issues now, that will lower our operating expenses moving forward. And just one more way we can increase the value of the asset.
All right, guys, so let's now break down the asset. The property is 184 units. It was built in 1968 and it spans across 24 buildings. All of them are two-story buildings on 8.3 acres. So 4 of the units are actually just studio apartments that are 330 square feet. We're going to convert those into kind of a learning center for the tenants, and that's actually that helped us apply and get a pilot payment in lieu of taxes, government kind of tax incentive to improve the condition of this property. Then 66 of the units are 1 bedroom, 1 bath, 670 square feet on average. And then the other 114 units are 2 bedroom, 1 bath units with 870 square feet. So currently the property is 95% occupied at purchase. We know not a lot of the tenants have been paying on time or at all, so we're gonna get out quite a few tenants and start renovating this. Currently, it's under market rent. The 1 bedroom, 1 bath units are renting for $550 a month. After our renovations on them, we're gonna increase the rents about $100 a month to $650 a month. The 2 bedroom, 1 bath units are renting for about $650 a month. We're gonna raise those rents up to $700 a month. And how we know we can raise these rents is we've already proven this theory. Graceland Flats is another apartment nearby that we own, and Shelby Point Townhomes. And both of them are pretty similar and nearby. And we've been able to raise those rents up to $750 or $700 a month, depending on the size and all of that. So we have a real good confidence and a lot of data to know that we can really raise these rents and prove that theory. In order to raise these rents, what we're doing is obviously an exterior large renovation. Then in the interior, we're going to make these properties nice, clean, and safe. we're going to probably make them the best units in the area for market rent, which will help them rent for top market dollar. We're going to put in, nice luxury vinyl plank floors, all nice cosmetic paint and molding and everything like that. We're going to be making sure the basics work on the property. So the mechanicals like the HVAC, already it was 90 degrees out and we had several HVAC work orders that we fixed. Make sure the water heaters work, the plumbing, electrical check, everything like that works. And then just freshening up the bathrooms and kitchens, some nice newer toilets and vanities, and making sure the countertops are all newer and fixing any of the cabinets where needed or replacing them. So just making it a nice, clean, safe area to live, really giving it a freshen up from all the deferred repairs that have been on this property. So yeah, that pretty much describes the asset. We're real excited for this property. Please like and subscribe to our YouTube channel. Like this video. Let us know your thoughts on here. We look forward to giving you more updates as time goes on and as we start turning this property around and getting it up to its former glory and making it look beautiful again, and really just treating these tenants right and making this a better place to live. So thank you so much, everyone. Have a great one.
Hey guys, Mark Hart here from MIP. Welcome to the next session for the 2021 SOFA Summit. This session is called the Property Deep Dive and Neighborhood Tour. First, we're going to start off and I'm going to take a deep dive into one specific property. We're going to go over the Google Drive folder, and in this folder, this is the marketing material that you'll be able to view on your own for every single one of our available rental properties. So this is the information that you'll use to make an educated decision to see if you'd like to move forward with the home or not. So I just kind of want to walk you through it from our perspective, just so you can understand it a little bit better. And then once that's completed, we're actually going to go visit Sean, who's actually at the property. He's going to give you a little walkthrough of what the home looks like before renovation, so when we actually bought it. And then you can see the finished product as well. It's great to see that transformation. And then finally, best of all, we want to bring Memphis to you. So we're going to drive around the car a little bit so you can actually see the tour of the neighborhood. So you get to know the difference between an A, B, or C class neighborhood here in Memphis, Tennessee. Let's dive in. All right, first things first, I always like to put the address in on Google Maps. We're going to go do a deep dive into another A-class neighborhood, this time in Cordova, Tennessee, out here on the east side of town. The address is 8600 Thorncliffe Drive. And what you'll notice here about Cordova, Tennessee that we really love is one, it is just to the north of Germantown, which is the highest income per capita in the entire state of Tennessee. So a lot of jobs, a lot of white collar jobs that need a lot of support staff, a lot of opportunities. There's also a major thoroughfare, 177, that connects the Wolf Chase Galleria, which is one of the largest shopping malls in the entire MSA of Memphis. Hence, another great opportunity for retail and employment, all the way down to Germantown. So this is a very popular place. A lot of our team members here at MIP and Reedy actually live in Cordova, and it's a great place to live and raise a family. So first things first, always like to drive the trusty old Google car around. Sometimes the old Google goes to the wrong place. It's actually up this hill a little bit, but it'll be fun to look at all the other properties around. As you can see from the architecture style, these properties are built in the 70s because they're a little funky, which is always fun. And this property here is located in a cul-de-sac, which is always a big plus from a renter standpoint. So this is our home tucked away back in here. And this is what the property looks like before renovation. As you can see, we're going to do some major tree work on the property here. All right, first things first, here's the Google Drive where we have all the marketing material ready to go for you to make an educated decision to see if this is something you would like to invest in. Up top will be all of the photos that we have. When you make the educated decision to move forward with the home, you'll only see the pre-renovation photos because we just started the renovation. But as the renovation goes on, we'll take updated progress photos so you can follow along, what you'll see here. And then at the very end, we will hire a third-party professional photographer to take professional photos as well as a drone footage, even of the roof. First things first here, I always like to go to the, oh, dog scared me a little bit there. It's okay, puppies. All right, always love to go to the pro forma here. The sales price is $229,900. That does include the renovation. This home is a 3-bedroom, 2-bath property, just under 2,000 square feet, built in, like I said, the 70s, 1974, with a 2-car garage. Neighborhood rating is an A, which means there's 90% or more homeowners, 10% or less renters. Cordova is a really great A-class neighborhood to where we actually will purchase and renovate and sell some properties just directly to homeowners because the after repair value is $300,000 or $400,000, a little bit too high to get good cash flow, but still a great, opportunity. And hence that's why we love Cordova, is because you get a lot of options. Essentially, this home here, we could have easily sold it to a homeowner, but we're in the business of helping investors build their portfolio and growing our management company. That's why we turn it into a rental. But one of the best exit strategies to have, one of the reasons people like A-class neighborhoods, is because down the road, they could sell to a homeowner as in addition to investors. Then also these A-class investments here, normally they're a little bit less risky because there's a higher rent. And normally the higher the rent, the more likely the tenant is going to do what you want them to do, which is ultimately just pay rent on time and take care of the property. Then these homes normally have a little bit less cash flow, but more long-term appreciation gains to where you could potentially do a 1031 or a cash out refi and double the size of your portfolio. So the way we kind of recommend properties to investors, if you're like myself, young, a millennial, trying to build a portfolio for the future, all right, $200 a month in cash flow now isn't really going to change my life, but I am trying to get financially free and build financial independence for 10 years down the road. And the fastest way to do that is to buy less properties in better neighborhoods. And it's also the least risky. So for younger millennials, I recommend the A-class properties. If you're in a different generation trying to achieve financial independence today or yesterday, that's where I recommend just looking at the highest cash on cash return of properties. Next up, target rent is $16.95 here. And yes, we actually are able to accomplish that rent. Properties in Memphis, they're renting for $2,000 and above. When it comes to these higher end A-class homes, there's less total tenant applications because there's just less people that will actually apply for it. But the tenant applicants are significantly stronger and get approved at a higher rate than, let's say, the C-class properties, where in a C-class home, there's more applicants, but more people get declined. So it's all a yin and a yang. And something like this, we can definitely rent very quickly here. So next up, it's a 5.93% cap rate. So that's the ROI in cash if you paid in cash. Then the cash flow on a monthly basis is $310 after maintenance reserves of $102 per month and after vacancy losses of almost $70 per month. So true gross cash flow, you would add those two together. That is going to give you a $3,721 per year in net cash flow, or a 7.6% cash on cash return, which is your initial cash invested of $49,230. That's your 20% down payment plus your estimated closing costs. and that's divided by your net annual cash flow of $3,721. Then when you add in the appreciation rate, which we put a 2.5% appreciation, which is extremely conservative. Cordova has been appreciating over 10%. That is $5,748 in equity. And when you divide that number by your initial cash invested, that's 11.7% annualized ROI. Then the mortgage principal reduction is $3,530 in equity. And when you divide that by your initial cash invested, it's a 7.2% ROI. And that gets better year over year as the AM schedules improve. And then your tax savings ROI, we're assuming a tax bracket of 33%. So this is simply taking your net cash flow times your tax bracket, which is an estimated tax savings. Always consult your CPA first, as we are not tax attorneys. And when you add it all up here, about 28.9% return on investment estimated. And these performance and projections are estimated and subject to change. The provider shall be held harmless if returns are not met. All investments have risks, and investors are urged to perform their own due diligence. All right, so that's the pro forma and the cash flow. Then I like to go over to the scope of work, where you can see, once again, new roof, new heat, new air, new water heater. Those are all going to be things that we're going to be spending money on to actually renovate. It's going to have all hard surface floors, whether that's LVP in the main rooms or tile in the wet rooms like the kitchen. It's going to have a dishwasher, no range, a vent hood, and no refrigerator. The tenant will bring all of those other appliances. You do not need to pay for them. And this is when we estimated the renovations to be done. It's in the past year, of course, but this is something that is subject to change, moving forward. Here's some wonderful FAQs that you can go over, at your leisure. Then next up is the purchase process checklist. If you want to follow along and check off each box, you can definitely do that. And finally is the Memphis Area Association of Realtors tax data. This is where you'll have all the details on the location, the property summary. You can see some of the sales history, the tax assessment. One of the big things is taxes get reassessed in Memphis every 4 years, not upon sale. And taxes just got reassessed in 2021. That means there's another 4 more years where taxes are going to remain virtually stable. Then here's where you can see the taxes change throughout the years, where they've gone down, they've gone up, but staying in the low $2,000 per year. Oh, there is a little fun fact here. In Memphis, you'll pay city taxes over here, as well as county taxes. The county is Shelby County here. There are certain areas within Memphis where you will not be subject to city taxes. You're only subject to county taxes. Thus, that will save you about $1,000 per year in expenses, and you can just add that to cash flow. So those are kind of the honey holes. If you ever see a property marketed from myself that says county only taxes, that's exactly what we're referring to. So then you can see some more characteristics from the building. The appraiser hasn't been appraised in a long time, assessed value, things of that nature. This is where you can also check to see if it's in a flood zone. If this zone code says AE, you definitely code red. You want to look and reach out to a lender to see if it requires flood insurance, because that could cost about $3,000 per year. And I don't recommend buying in a flood zone unless you're getting a really, really good deal. And then finally, home inspection. Once the renovations are done, we will help you get a home inspection from a third-party independent inspector. Always really important there. And when the report comes back, we get about 5 to 10 items, that come back on the report that we'll send that report to the construction team, and they'll make almost all the repairs for free at no additional cost to you. And if there is 1 or 2 items that we won't fix, that's just because we wouldn't do it on our own properties as well. So once there are those 5 to 10 items, we'll put it on a really pretty little Word document here with photos of kind of going over what was the item, saying that it's completed, and just trying to make it, really easy on you. All right, so that is the Google Drive for 8600 Thorncliffe in Cordova, an A-class neighborhood. Let's go over to the property itself, where you can see a before and after renovation walkthrough with Sean, and he's also going to take you around the neighborhood as well, so you can get a real look and feel of what Cordova and an A-class neighborhood looks like.
What's up, everyone? Sean Tagge here, chiming in with another video. This is 8600 Thorncliffe Fairway. It's up in Cordova. Really nice neighborhood, lots of homeowners in this neighborhood, and it just squeaks by to make sense to be as a rental property, but in a highly appreciating neighborhood. We do a lot of flips here where we sell them to homeowners. We do a few where we sell them to turnkey investors. So really nice neighborhood. This is an awesome looking, kind of contemporary looking house. We are just about a little more than midway through the renovation on this property. You'll see we've repainted the exterior, new roof and everything like that. Great property, great area. As the crow flies, I'm probably about 3 or 4 miles, actually probably 2 or 3 miles just north of here, my personal residence. So yeah, definitely really like this area. Bartlett just comes north. So yeah, let's walk on through. We can kind of graze around the property as we're looking around in the back. We've trimmed a lot of the tree branches that were overhanging on the property to obviously reduce the chances of tree limbs falling onto the house and damaging them. Pretty nice curb appeal, nice little zen in the springtime. This will all be looking really awesome. We've gone ahead, a little white trim on kind of a greenish, brownish color here. We have a nice 2-car garage over here. It actually has a little bathroom on the side. And yeah, here we can stroll around to this garage here. So obviously our contractor, Derek, has blue taped the crap out of all of this area just to keep on his guys, making sure everything's looking perfect. Sorry about that. I'll probably need to blue tape that. So here's the 2-car garage. Nice functional garage, really nice bonus, detached, kind of be used as a little shop or something. That's pretty awesome, a little man cave or something. So grazing through the backyard, pretty nice there, a little zen going on. You could have a little concrete right here to kind of eat and relax. I really like this area, nice, quiet neighborhood. Beautiful looking exterior, back and everything like that. We got the black doors, nice new poppin' stainless steel features, exterior lights. Mind the renovation, it's gonna be a little noisy. We have our guys laying stick down floor, for that nice luxury vinyl plank. We picked some higher end for that, so mind the renovation, but yeah, it's definitely rolling along. Oops. So we have all of our floors ready to go, gonna be laid in later on today. Obviously pretty far along on this reno, paint and everything like that, new lighting, can lights in here. So just watch out for these things. You can kind of just pop around in there. The guy's over there laying the stick down. It's pretty awesome. So popping along over here, here's one of the bedrooms. A his and her closet, that's always nice. So pretty nice spacious bedroom. Here is one of the master baths. I'll just let you kind of graze along in there. We're going in here. All right, so here's the kitchen. Luckily we made it just in time to where they don't have this whole place with some stick down, so that's pretty awesome. But yeah, they're in here laying this down. That's a really kind of awesome process to watch. It chemically seals to the floor, get you a nice great sealing and bond for that luxury vinyl plank, creates that kind of like waterproof seal. It's awesome. So yeah. Okay. Hello. All right, let's go over here on this side of the property. I think that's a new furnace. Lennox. That's a really nice brand furnace. Watch out for some stick down over there. So here is a hallway bathroom. Pretty nice, pretty spacious, you know. Gets the job done. Obviously, we'll be rolling along on the reno for you to like kind of pop in there and check it out. Okay, so looks like we've prepped this floor. Looks like they'll be getting the stick down in here. But yeah, here's another good bedroom, good sized bedroom actually. I like it. All right, let's pop on in upstairs. Oops. This fireplace. It's a cool little rustic staircase. Oh, okay, so just the attic space, we put in a new water heater. So that's pretty nice, you know, got some good storage for the tenants when they need it. This little den area here can make it your hangout, TV or something. Okay, and just another little attic space. So kind of interesting, you could theoretically put another bedroom in here. Well, it'd be really small, but anyways, just stuff to think about. If a homeowner went in here and as prices per square foot go up in the next several years, that would be something to consider, is put a bedroom in up here or make this kind of a larger bedroom area. Anyways, stuff to think about. So anyways, there's the property. Thanks for checking it out. We'll be showing you the after once this property is done. And yeah, chiming in for another video. Thank you so much. All right, guys, we have made it to 8600 Thorncliffe Fairway, a beautiful property, just finished with the renovation. Buyer is going through the home inspection and appraisal on this property right now. And this is in Cordova, so a really nice neighborhood, a lot of homeowners in this neighborhood. Very hard to get a rental in this neighborhood because houses are just increasing as we're going around. So let's go on in and check out the property. So we did a exterior paint job around the whole house. Some white on some like off green, grayish color. Really like that. So last time we were in here, they're laying down the floors. Here they are, the luxury vinyl plank going around in here. So we have over here the beautiful luxury vinyl plank floors. Then coming around over here, we have the kitchen. So we refinished the cabinets. They were in great shape. We just refinished them and put some nice paint on there, some nice stainless steel knobs, nice stainless steel appliances, oven, washing machine, refrigerator, everything like that, vent-a-hood. And if you come around here, here is the master bedroom. Some closets on each side, just nice cosmetic renovation, new ceiling fan, new light fixtures, new plug switches, vent covers in most of the areas. We got new vanities in this bathroom. The tile was in good shape, so we kept that, and a new toilet. So there's everything in there. Okay, so then when we come around here, and kind of the little sitting area, then around here is another bedroom. Nice basic features, sorry about that. And then in the middle of these two bedrooms is a bathroom, which we just basically cleaned up a bit. It's pretty decent shape as it is. You can go in there. Then here's another bedroom. Pretty decent shape. And then there is an upstairs as we showed last time, so let's go up into there. Well, here actually it's probably easier before we go upstairs. We'll just show you the backyard and we can finish with that. So the AC was already in good shape, so we just fixed it up, tuned it up. It's ready to rock and roll. That's a great brand, Lennox. And then yeah, here's the backyard. We cleaned it up, did a lot of landscaping, everything like that. And yeah, and then the two-car garage is rolling with everything like that. We fixed the gate fence, so that's easy to open and close. All right, now let's finish with the upstairs. Kind of like a bonus room, bonus area upstairs. Could be your man cave or your woman cave, I guess upstairs cave, I don't know what those are called. So yeah, just a nice clean area. Then around here there is attic, lots of attic space. We put in a new water heater, but yes, some nice, it goes kind of back in the rafters there, but lots of storage when that's all cleaned up. So yeah, that's pretty much it, guys. Thank you so much for checking out 8600 Thorncliffe Fairway. That's all we have for you today. Another property by Memphis Investment Properties. Have a good one. Alrighty, guys.
Ooh, that
wow.
was it. I can't believe it's over.
We're done. I gotta get my shoes
Man.
back on, man. It's been that long. 5 full days, no
Man,
shoes.
I need a drink. It's Friday.
Yeah,
Come on.
geez, the same spot every day. Well, guys, I'm super grateful for everyone here. All your comments, serious or silly ones. We really appreciate everyone here hanging out with us for these past 5 days, learning with us on how to become a cash flow king.
Definitely. So what was your biggest takeaway, would you say, for the
From
day?
today? I just love teaching. I love teaching people and helping people understand a little bit behind the math and the science, the creativity, the pros and cons of real estate and investing. So I love just kind of doing that. That was kind of fun for me to talk about multifamily investing.
Yeah, and I just love diving into the 1031 exchange with the IRS code, because essentially it is a tool that is given to us as long as we have the right team in place to utilize it. Right? I would not want to be able to try to go down that path on my own. That's why you just need to have the best team in place and hire an expert like Scott, who's done this hundreds of thousands of times and is definitely someone, that we would recommend. So that's it.
That about wraps it up today, guys. Let us know your last final thoughts on what you learned today, and we look forward to reading it. I guess on to next year.
On to
we'll
next
see you guys
year.
later.
Thank you, guys. Signing off.